Hello, everybody. We have actually pretty interesting subject, and I have quite an experienced, very deeply involved participants on the panel in the today's and in the last decades banking world. So with that, I propose we start the discussion. I hope everybody can see my screen, and we cannot hear you, just so you know, but you have a way how to ask questions, which I'm going to show you in a minute. Before that, today we would like to make it very interactive, so you can ask questions at any point of time, and you can ask questions during the presentations after that, and we are going to be following your questions. After each presentation, I'll be stopping and seeing what are the interesting things related to that presentation. And then, of course, at the end, we're going to have a Q&A session. For now, maybe we can start with introduction of who is on the panel today. Actually, I hope you can see my screen. So very quickly about me, my name is Narada. I'm CEO of Software Group. We are deeply involved in the process that are happening today. As for the past decade, we have been helping different financial service providers around the globe to transform to digital and to utilize the technology in the right way. And I have today with me Philip Genov, CEO of F27, a company that is also deeply involved in digital transformation. Philip, maybe a few words for you.
Hello, thank you, Colin, for having me, and hello to my fellow panelists and to everybody that was so kind to attend. Couple of words of me. I have spent the last 30 years of my life in banking and finance, mostly involved in anything with respect to digitalization, innovations, introducing of new products and services. I've set a number of quite well performing financial institutions as well. And that thing was in the area mostly of Eastern Europe, Germany and Italy. And I'm really thrilled today that we'll be able to discuss with the other distinguished panelists what is happening with COVID and with the banks in different parts of the world.
Okay, thank you, Philip. Then we have Marie Gardner, who is Managing Director of Blue Coat Africa, also with a long experience in digital transformation projects. Marie, maybe a few words about you.
Sure, thanks, Kalen. Yeah, I've spent my career trying to address some of the challenges of access to finance. Financial inclusion is what we describe as the mission today, but started with supply-side credit and microfinance journey. And I built a vertical market within a large listed fintech company, providing core banking services around the world. And we built up a portfolio of about 240 banks in 47 countries. So I've had the good opportunity to try and engage with people and bankers and the nonprofit sector across the world over the past 35 years. And more recently, with the wave of digital transformation and the new experience that we're all having with the digital world and communications, I've become much more involved on the payment side and digital transactions, which is what Blue Coat is all about. I'm very excited to be here today and meet with you and the rest of the panelists. Thanks.
Thank you, Marie. And then last but not least, we have Rich Longo, who is also managing partner and somebody who is running digital transformation projects around the globe. He has been deeply involved in so many strategy decisions in big vendors in the past. I believe Rich can tell us a little bit more about himself. Rich?
Yes, thanks, Kalen. Thank you for inviting me and being here. over 20 years of experience in financial technology, fintech, like you alluded to, in digital transformation. I was involved in building the first app store for core banking back in 2009 with a company called Open Solutions. I was involved in building a brand new core system out here in the US back in 2011, involved with Temenos and helping them grow the US market in North America. And after that, spending some time at Emphasis, responsible for global strategy and helping to grow their solutions business. Today I'm very involved in helping financial institutions monetizing, automating, and connecting their data. And we're seeing a lot of importance around that, especially after COVID. So eager to have a conversation.
Okay, thank you, Rich. And I hope the audience is able to see where this conversation is going. We gathered today people that have been involved in decades in those digital transformations and have vast experience in those processes. So we are hoping that today we can discuss how the banks actually can win against the new threats and some of the old threats that have speed up because of the situation. We hope to get answers. We hope to have a very interactive discussion through to your questions. Actually, here is the moment maybe to guide you a little bit. If you open the panel for management of the webinar, you're going to see a section called questions. This is where you can actually ask the questions, as I already mentioned, anytime during the presentation. Our assistants are going to help us to select which questions are mostly asked and where we have repetition, so the interest is high. And we are going to use the pauses between the presentations and also at the end to do so. With that said, I think we can proceed with the discussions. I believe it's very, very clear to everybody, and as you're showing interest, I'm sure you know why you're here. Basically, we are seeing vast, very quick changing process, very quickly transformations are happening, which usually would have taken years. Now we see them happening for months. And I believe everybody will agree with me. What's most interesting here is that once the people gets into digital, they don't go back to the usual services through branches. They don't want to queue anymore. And once they touch and they actually jump over this barrier, where we are seeing that mobile, web, other digital channels are working, they're easy to use, it's convenient, it's cheaper even in most of the cases, then obviously the customers are going there. You can see the numbers from various researches, but everybody and everything shows the same way. The process has been speeded up by a dramatic magnitude, and we are seeing that even if the organizations are not fully ready, the banks, the non-banking financial services organizations and others may not be fully ready to provide the services to the best digital way. The customers, the market is now ready. So here are all the questions that are coming away. How that's going to impact the banking world? Are the fintechs are going to take over? Are they going to actually take a lion part of it now? Are the banks in a position to actually respond to that, be very agile, something that many of them has been trying for years and some succeeding very well, some being a little bit more slower. So along these lines is the discussions today. And from our experience from Software Group, we are seeing the increased interest from existing customers, from requests that are coming only now, that there are some areas where the interest is extremely high. Of course, this is remote digital onboarding, remote loan origination, fully automated processes, but everything kind of implies one and the same thing. The banks today need a stable, flexible platform to be able to respond to the market needs very quickly. So the old projects of we are going to implement something for 2-3 years and then we are going to think about it, or we are going to have multiple silos where they're going to work independently, those things are gone. Now, to be able to actually participate in the market, the platform needs to be there. Now, with that said, we are running into multiple conclusions, but I would let now our panelists to show us what they have as analysis, what they have as outcomes, and of course to share a lot of the experience that they have in this area. So, Philip, maybe you can start.
So, without much ado, I will start straight from where you left. Digitalization in the means of introducing distant, mobile, more flexible models, platforms, it's a total must. But I would like to touch a little bit on something else. Banks need to become smarter. And I cannot underline it heavier than that. There is a significant increase coming in the area of distressed companies and NPLs. Market, but by market it varies. In this case, I have shown the example of my home country, where financial institutions should expect an additional increase in their NPLs of approximately 8%. And it varies sector by sector. No surprise, hospitality is with the worst impact. Some industries are not so badly impacted. But where do we stand on that? Our models, our metrics are in dire need to be updated as an approach and content. Because in the way it is happening right now, financial information for 2019 for all the needs for scorecards, metrics, and so on does not tell us a lot. At the same time, behavior aggregations, variety of different governments doing different things, and this is impacting dramatically all the import-export companies. Number of geographies to monitor, the speed of the need to react and implement is increasingly becoming more challenging, and staying in the comfort zone of the approved fixed models where you update the big macroeconomic data, budget, etc., once or twice per year is not going to help a lot. I mean, if you stay in this comfort zone, you will land with 10% increase in the NPL. And if you go to the next slide, this is how Europe is currently reacting. These are the 6 main relief measures that are being implemented by the top 20 banks within the European Union. What strikes here is that the same measures were implemented in the previous crisis and the one before that and the one before that, and I believe this is more or less since banking has been invented in Italy somewhere in the 13th century. And at the same time, technology is definitely not there. And I cannot again emphasize on this more, because you can be mobile, you can be digital, you can be on a platform, but if your decision making is old-fashioned, if your reaction is like 20, 30, 50 years ago, that will not take you far. And I will not step on each and every one of them, but even yesterday I have had this conversation with the deputy governor of the central bank here and saying, guys, collateral, I mean, give us a break. First, it's depreciating quickly, and then again, we are still selling assets from the previous crisis. And there is something which, there is an area which every bank needs to very strongly reassess, and this is how middle and upper management is getting information. In most cases, the bank or the institution can have everything that they need. Technology, IT is sufficiently empowered in most cases. The situation is breaking badly at the moment when this information needs to land on the table of the board. And in that scenario, Microsoft Excel, Microsoft PowerPoint, distributed by email, is still used by more than 90% of the financial institutions, but it's also going to telecoms, utilities, and so on. And this is the most crucial thing that the bank needs to do, and it is very difficult to do, because this is a change that impacts the C-level floor. But if you do not do this, you're going digital, and arming yourself with any kind of technology is going to be futile. And there is another remedy. I believe it's not very difficult to do from the point of steps to undertake. There are three very simple ingredients missing. We call it strategic data science. The other one is visual engineering. But when we say C-level visual engineering, it means that we need to empower the managerial staff across the company with all the access and all the data served in a way that they are CEOs of their domain, of what they are responsible for. And the third one is connected data. And I will go one by one very quickly in order to save time. If we can go to the next slide. Together with our friends from Boston Consulting Group, we have mapped 423 data silos and groups of databases across a commercial banking organization. And we go to the concept of enterprise risk management. And this is something which allows the bank not only to set the objectives, but one of the most misunderstood concepts in banking is opportunity risk. In our industry, we are very good at handling credit, operational, and so on. But handling the opportunity risk is the next make it or break it point in banking, because this is the source where, when you link it with the information, you can make the decisions. And this is how should look the dashboard of a middle or senior manager in a financial institution. Immediate, connected, visual, actionable insights. Not Excel, not PowerPoint. You need to have this interactive working with you. Connected data. Another very, very dramatic point across most of the banks in Europe, but I would dare to challenge that this is maybe global phenomenon. Banks are buying gazillion of databases, and this is the gray bar. The orange one gives what information is used in the internal metrics, scorecards, and so on. And the red one is what is used for interactive, immediate, daily decision making, which means most of the decisions made by financial institutions are done offline and entirely based on internal information. This is where technological sector, all the Googles and Facebooks of the world are killing our industry. I mean, if we are not as bankers able to link ourselves to the development, we are out. And that being said, I'm finishing my little bit emotional expose, but I really love banking and I would love our industry to move forward. Thank you, Colin, for that.
Thank you, Philip. That was very, very powerful and actually dragging the attention to something that people, I believe, always assume that when you have a system and when you have a platform and when you are spending a lot on IT budgets, then automatically everything falls in place. But I believe the point made here is very, very important, that no matter that the operational system may be in place, on the top of them, the control and the management systems are also very much needed if we want the effect of the whole digitalization and the whole quick decision making to take place. Actually, Philip, there are a few questions for you. There is a group of participants actually that are more stating that this is quite difficult to organize, and also that they have in their business, obviously, some challenges in integrating between the operational systems and the management systems. So they're asking for more or less advice in that area. Do you have anything to tell them about?
Yes,
that?
Good news and bad news. Good news.
Okay.
And actually, I will start with the bad news. I have been fighting within a very big European bank with this phenomenon, and in the end of the day, I have discovered that it is easier to do it from outside of the organization. So it is very difficult to overcome the internal data silos, and this is a challenge that every bank needs to face. Another bad component of the bad news here is that the more you implement mobile and digital, the more is the demand for you to accelerate the decision-making process. If you put a modern integration platform and if you put a mobile wallet, your decision-making should be within a couple of days when you need to react. And this is part of the bad news. The good news, the more you connect your data to the external sources, the less dependent you are on the internal fragmentation. We can help on this. So hit us, hurt us. I would ask to the organizers to give my email. So this is a long story, but it is solvable.
Okay. Actually, integration seems to be a topic in many of the questions, but I see one that is very much related to the today's situation. There are participants, several of them, that are asking about fine. What you guys are explaining is, I'm transforming a little bit the question to summarize them, is good, but it's valid for any kind of moment in history that we should be integrated. We should have obviously flexible platforms to be able to react to our time to market to be low, to be low cost, and all sorts of things like that. But today's crisis is actually not of a financial nature. So nothing like this has been captured in the past. And the participants are asking, like, how do we use the data from the past, from 2018, 19, 17, and so on, to compare and relate to what's going on today? I think quite a COVID type of question. So, Philip, any suggestions?
Yes, gamification is the name. We have developed specifically for a number of banks adjustments for the risk scores based on the COVID and post-COVID performance. The best thing about past data is that you can cluster and do simulations and link them to the transactional information of today. And this is something which we have been extremely successful, and our objective is to at least half the impact of the coming NPLs for each and every of our customers. It is solved, it is doable, so let us, get us in touch and we can build on this.
Okay, if I am actually understanding you correctly, what you mean is first get the past information, cluster the customers, then apply what you were showing on your first slide, the expectation about this particular cluster or sector or target group, and then actually treat the particular customer both from the perspective of what is their transactional data today, modeling from the past, but also like being part of that group that has a specific impact from COVID, correct?
Absolutely, and two more things to that. I don't want to hijack the conversation in that direction too much, but it's been done already. In the previous crisis, we have implemented the first version of transaction adjustments or risk measurement based on transactions in order to fight the coming NPLs, and we have managed to decrease the cost of risk of the biggest bank in Central Eastern Europe to below of 1%. And I'm talking about 2010, 2009. Now we are even better in that, but past information, daily monitoring of transactional trends, and monitoring of the outside world and monitoring of government measures, there are 11 sets which we bring together. But it's solvable, it's done.
Okay. Thank you very much. There are many other questions to you, but I'll leave them for the Q&A session, so we can give the opportunity for our next panelist, Gardner. to also share what is he observing, what's happening in Africa, compare maybe a little bit to Europe, what Philip was presenting, and also share some of the insights and maybe ideas that can be applied to other parts of the world as well. Murray? No problem.
Thanks very much, Galen. I don't think that we have a real idea of what the impact of this pandemic is going to be across the African continent. The news cycle is absorbed with what's happening in Europe and particularly what's happening in America with the pandemic and the impact on the economies. But Africa is in for a big hit. A lot of the countries in Africa have instituted some very strict controls, but Africa doesn't have the capacity to deal with the pandemic. It doesn't have the hospital beds. And all the formal industries that we have across the continent are impacted heavily by shutdowns and lockdowns, which have had to be very severe. You consider the demographics of the continent as well, and the social and economic conditions are dramatic. I live in South Africa. There's 7.7 million people out of a population of 57 million. 7.7 million people here are living with HIV, compromised immune systems. We have a large population of people who are being managed with tuberculosis. We have 24% reported unemployment. It's a lot higher, and South Africa has a highly centralized economy. So when factories shut down, when the service sector shut down, it throws hundreds of thousands of people into the street. Nigeria and Ghana, for example, have a much larger domestic economy, so the ability to absorb some of the shocks are better, but they have dramatic numbers. So you look at this continent, and the reported numbers are reported against what testing is possible to do. We don't know what the situation is going to be in 6 months' time, but look at the curve, the demographic curve, a growth curve over time, and this is one of the big drivers of digital activity in Africa. Africa has 54 different jurisdictions, 54 countries, but the demographic curve is pointing upwards. Every other continent in the world is flattening their demographic curve. The population growth is flattening and declining. India, Asia, North America, everywhere. Europe, flat. Africa is still on the rise, and that's a direct correlation to the economic conditions. So it's never been more important to be able to generate economic development and GDP growth in Africa. And that's the only way out of this situation. It always has been, but now it's much more imperative. I focus on certain countries, and I've divided up some examples here. The countries in red I would describe as countries that have growth and scale, relatively high bank populations. The adult population of these countries on average is close to 60%. That's between the ages of 15 and 64. Economically active adults, and the bank population is upwards of 50%. And when we say bank, someone with an account of some kind where they can do some kind of transaction. The countries in green are hot on the heels in terms of scale and opportunity for growth, and a lot of fintech innovation is happening in them. And the countries that are in pink, which are kind of blotted out by the bubbles there, but are what I would refer to as sleeping giants. Huge populations, very poor infrastructure, not yet there in terms of digital financial inclusion, with average financial inclusion rates of 23%. So what can digitalization do to stimulate economic growth, to absorb the population that needs to be gainfully employed, needs to contribute to the economy? And it's all about digital. Africa leapfrogged the telecommunications story with mobile telephony. The phenomenon of Safaricom's M-Pesa has inspired countries all over the world, but particularly in Africa, for a P2P payment, a P2P interaction. Started with rural remittances and has grown to be a very big impact. In fact, it's socialized East Africa, where people typically are much more trusting of a digital interaction, whereas in the West, it's much more card-centric, or at least card-related, or card thinking in terms of payment interactions. But for all the activity you hear in Africa, only 1% of the payments that are made, or financial interactions that are made, are digital. The rest is cash. And that's because people make about 1,500 cash payments a year. And that's a taxi driver, it's something for lunch, a loaf of bread, something to bring home. These are cash interactions. And so cash is still the medium of exchange. And if you have a business in Africa that is dependent on cash or dependent on P2P payments, you don't have sight of that business. And if a business is opaque and it's opaque to the bank, then it's impossible to finance the business, to provide any kind of support to that business, to be able to stimulate development, to provide cash flow-based lending, insurance, savings, transactional banking, and so forth that are necessary for a business to grow. Supply side management, all the other things that we take for granted in an SME, the SMME sector and the informal sector is primarily locked out for lack of digital transparency. I was asked to talk about some things that I saw that might be the key drivers or the key changes or the key influencers with this COVID pandemic. And as I was saying in the previous segment, I don't think there's anything more important than the digital transformation. And I think that the crisis, the economic crisis that is brought on by this pandemic and the economic shock. And remember, Africa can't just print money. It has to buy everything in foreign exchange. So it means debt. Where a country like the United States can print money and future generations will fund it and inflation will eat it over time. African countries have to borrow money in foreign exchange, and they oftentimes have poor credit ratings, so it's horribly expensive response. So protecting the economy and having a digital interaction where we can have low cost, easy digital interactions and data to be able to see business is absolutely critical to stimulate GDP. So the four things I picked out that I thought were important that I've observed is national governments are focusing very much on domestic payment schemes, digital domestic payment schemes, and they're settling in on the EMV QR code with a customer push payment as the primary instrument of payment. It's cheap, it's cost effective. A small business can have a static QR code on their shop or their kiosk, and a customer can use a mobile phone, scan that, basically picks up the merchant's information, and it sends a message to the bank to pay this merchant that amount of money, and it goes across an instant EFT switch. That's becoming pervasive. All countries have got some kind of strategy for that. Ghana has been the first to launch with that, and that's mitigating against foreign dependency and dependency on foreign card schemes. The need to pay foreign exchange to manage domestic payments doesn't make any sense. So that's a big initiative, and that I think is going to become a standard. It has limitations because it's a push payment and it really implies opacity with the business. The acquiring bank for that business can't see anything other than credit transactions coming through. The next big change, or the next big field of influence, I think, is with open APIs. In Europe, you have SEPA. Europe, you have open banking, where the consumer can actually shop fintech and connect their bank to a fintech app and draw data out of their bank and aggregate and do all sorts of interesting things with their data. African countries they're not there yet with that, but a lot of banks are taking a strategy of open APIs and connecting to API platforms or building their own API platforms to be able to shop fintech marketplaces, try something, try a new social interaction, try to focus in on the customer and give a customer social experience so they can engage with the bank in a meaningful way. And there's a really dynamic fintech market in Africa, Nigeria and Kenya being the two big centers for fintech development. In Africa, and all sorts of great innovation in Africa, mostly African companies interacting. So the ability of a bank strategy to expose itself through APIs to be able to have a dynamic and fluid experience is a big change agent. Some banks are starting off, some banks will just keep the old fortress on one side and spin off a challenger bank themselves, a subsidiary, and try and drive change that way. And then there's new configurations of capital launching brand new challenger banks that are entirely digital, but they're fairly narrow in their functionality. Another factor that I think is driving the shape of fintech and the way that countries are responding is the adversity, or not adversity, the anxiety about offshore dependency, even on cloud computing like Amazon Web Services or Microsoft Azure. But in principle, the big aversion is towards the foreign card schemes, Visa, MasterCard, to a smaller degree Union Pay, and then the inbound big tech, Google, Amazon. Just today there was an announcement about WhatsApp Pay launched by Facebook in Brazil. The big tech is in the market really to gather data, offer very cheap interactions, very simple kind of transactions, just payments. But the card scheme's the card scheme. They built up a brand, a legacy offshore scheme that they've been able to manage and own, and that's their principal asset. So they're doing card virtualization, disintermediating some of their traditional partners in terms of the plastic and PCI machines, POS terminals, and get rid of that to go virtual. But it still engenders a dependency on offshore schemes. And with this world of deglobalization and anxiety about sanctions, that causes the regulators a lot of anxiety. And the last one that's directly related to what's happening in banking in Africa is a genuine aversion to a tactile interaction with a payment, handling cash, touching biometric devices, touching anything, touching a POS terminal. That mostly is in the top quintile of the market where people have cards and are interacting that way. Cash, you can't get away from it. We're not really sure how much the science backs up the fact that virus is transmitted with cash. There have been some studies done on different types of cash textures, but still, it's a tactile experience. People are averse to it, and that behavior itself is going to drive digital adoption, because one of the biggest challenges with digital adoption is consumer behavior. How do you create an incentive for somebody to change their behavior as a consumer and as a business? The essential message that I would say out of my presentation here is that we have to be very cognizant of the need to pivot our whole experience in development, economic development and financial inclusion, pivot from the consumer and pivot that to the productive economy. If we don't find a way to digitally light up the productive economy, the small farmer, the small trader, the artisan, the business of any kind, we have to light them up with data, and you do that with transactional data, and only then can a bank that business, because a business is just data. We can't afford to go and see a business, check the inventory, see how they're doing. We have to be able to view them like we view consumers, with data. So data-driven analytics to be able to provide the financial services that will create the relationship with the payment interaction to quality financial services as a kind of quid pro quo for using digital services for an SME. There's lots of reasons they like cash and lots of reasons they don't like digital, lots of them, and they're good reasons. But if you exchange your data and you exchange digital transparency, you need to exchange it for something. That has to be quality financial services. And that's what small business needs. And that's going to stimulate the development. That's going to absorb the shock of this pandemic. And I believe that we're going to see, as Kaylin mentioned earlier, we're going to see what would have taken 5 or 7 years take place in 12 or 18 months. Thank you very much.
Okay, thank you, Marie, so much. I actually, I was really astonished by the graph that you started with about this growing population in Africa in the next decades. Actually, thinking about that, this population will need to work somewhere, and we can, of course, anticipate a lot of factories will be built from for different needs. But I personally think something that maybe we discussed in the past with you, that that population will need to be actually engaged into a local economy, and this local economy definitely will need the financial side of it to be able to support everything. As I can see 2-3 questions related to that, maybe you can elaborate on that a little bit.
Yeah, absolutely, Kaylin, 100% right. The next billion people on this planet are going to be African. Already, Africans represent about 25% of the world population. The next billion come. The rest of the world is flat, but African women are on average bearing 5.1 children. And that's because of infant mortality rates. All of the reasons that people have a lot of kids relate to their economic conditions. The wealthier we are, the more costly kids are, and the greater their survival rate, so the less the need to have so many children. And that's just kind of an ingrained behavior of all human beings everywhere. So Africa has to grow its domestic economy. And some countries, Ghana, I think, has got 65%, sorry, Nigeria and Ghana, they're very similar. They have a very large local agro-processing industry, small farmers. Small farmers produce goods, somebody processes, someone buys and sells. It all happens out there in the rural areas. If you look at South Africa, vegetables are grown on big farms that employ people, transport people back and forth to big farms who transport agricultural goods in big trucks to big shopping centers where people who live outside of town have to get on a taxi and pay cash to go and buy cabbage. So you've got a highly centralized and structured production system. You hit that with the COVID and you've got lots of unemployed people. You hit Nigeria with the COVID, you have an economy that isn't going to fall apart. Of course, we won't get into the structure of oil, and they're trying to pivot to agriculture, but it's the agricultural and agro-processing in the domestic economy that's going to be the buffer, and that's got to absorb this population. And then with digitization, and you can just imagine the future with an open digital world, and all that enables in terms of the means of production and the way the economy is organized. And it all has to do with digital financial interaction. So fintech is absolutely fundamental to flattening the growth curve. We're not just talking about the pandemic curve, but the actual demographic growth curve of this continent is unstoppable without domestic GDP growth. And we have to pivot all of our experience with data, pivot to that economy, because it's still locked out. It's still dark.
Okay, very, very interesting. Actually, I see about 7 or 8 questions related to, particularly to the QR code payments. And this is something that we are seeing also in Europe. Quite an impressive growth in countries like Austria or other quite developed markets. Can you a little bit elaborate more on that? The questions are varying from like, is that the new standard? Is it done only to avoid the Visa and MasterCard payment schemes, all the way to, is that the most convenient way to pay? And also there is a question about security. You mentioned some static QR code payments. Here, 3 participants are kind of elaborating that dynamic QR code payments are maybe also under consideration. So your comments on this kind of a whole group of questions.
Sure. There's two kinds of payment. There's a push and a pull. We're talking about either the merchant pushes the payment to, either the customer pushes the payment to the merchant, or the customer presents some information and the merchant pulls that information and makes the request themselves from the customer account. So if you think about a credit card transaction, that's a pull. You present the credit card, you're presenting your personal information on that card. It's got all your data. So you have to put it into an encrypted POS terminal or some kind of device that can read that encrypted data, enrich it with a request from the cash register or from the merchant to say, I want to use Kalen's personal information and his bank, and I want to ask for 50 euros payment, and then it sends it off to the scheme, and the scheme says, oh, this belongs to bank A. Bank A, does Kalen have the money? Yes, set it aside, send it back a message, it's okay, and credit the merchant's account. That's a scheme. That's a merchant pull. That requires a scheme. So the QR, EMV QR is becoming a standard, and a lot of people will argue that it's an inferior QR because EMV stands for Eurocard, MasterCard, and Visa, for example. Yes. That's where the standard comes from. The card companies that own those offshore schemes are pressing really hard to maintain those schemes. That's where they make their money, a transaction fee on processing the transaction to route it from the customer, enriched by the merchant, to route it to the customer's issuing bank account, and then to send a message to the acquiring bank account that owns the merchant and credit them and manage all the interactions like a reversal and arbitration, all that. So that's the scheme. That's the value in Visa, MasterCard. So they're going virtual, and the QR code is the instrument for that virtual payment. So the EMV standard is, I believe, becoming the standard in most emerging markets. Now, what countries are doing, like if you look at what Ghana has just done, they set up a switch and they force all the banks to connect to the switch. So now you can do a payment out of your account based upon a QR code. All the QR code is data. Now, it's just a presentation of information about that merchant. So if you set up Kalen's Coffee Shop, you can be acquired by Bank A, and you can say, I'd like to have an account with Bank A. They say, download this QR code, which has your information. It says Kalen's Coffee Shop, the address, your bank account, bank number, and so forth, your BIN number, and so forth. And you stick that on your shop. I come in with a camera on my phone, and I take a picture of that. And my app reads that, and it says, that's Kalen, and it's a coffee shop. And then my app says, what do you want to do? And I say, well, I want to pay 10 euros. So I enrich it, and it sends it off to a switch. And the switch is going to route it and do the instant settlement. So an instant EFT owned by the banks or owned by a domestic interest or domestic scheme is now using that standard. That's becoming ubiquitous, but it's very much targeted at the lower end of the market, because with that type of payment, you have no value-added services for the merchant. It's like a cell phone P2P payment. Because if you look at the Lipa na Pesa example in Kenya, or any of the other big MNOs that have tried P2P for merchants, you get a merchant number. So you get a merchant number, and then instead of all you're doing is you're doing an SMS or a P2P payment to that merchant number, and then they get an SMS confirmation of the payment. So the QR code is very much the same. It's just a little more intelligent. Instead of you having to type in a merchant number and send a P2P, you use an app to read that information and send the P2P message off to go and pay. So it's a simple, basic customer push standard, but it's easy, it's cheap, and it is becoming fairly ubiquitous. The problem is it's not scaling. I mean, I was talking to one bank that has over 30 million customers in a wallet across a number of countries, and their problem is their QR code payment isn't scaling, and it isn't scaling because the merchants don't care. They don't want it. Why did they would rather? They're accustomed to cash, because one of the there's many problems on the digital side for a merchant. But to go back to your question without elaborating too much, it is a simple, like a P2P push payment from the customer, and it doesn't do much for dealing with the opacity issue for the merchant in terms of digital transparency, and not a lot of incentives for the merchant to use it. But it is the standard.
Thank you very much. I think for those, and there are a few more questions exactly asking for the details, so your answer was just on spot for understanding how it works and what it is. Let's see now what Rich has to tell us, and maybe Rich, these QR code payments, are they also in America besides Europe and Africa? Do we see them also in America?
Really, truly, we're not seeing it on a massive scale like you would see it in China or in some other parts of the world. If you are seeing it, you're seeing it for app-specific rewards. So, for example, if you use your payment on the Starbucks app and you pay with Starbucks, they give you some additional points. But in terms of replacing that plastic card, or even the adoption of replacing the plastic card for Google Pay or Samsung Pay or Apple Pay, you're not seeing at the rapid adoption that you're seeing in other parts of the world. So, and I think it comes down to a cultural difference of how, people in North America at least see how they want to bank.
Okay, I can see Thelma from Ghana is agreeing with Murray on the 1% of the transactions only being done digital. So let's focus also on that, Rich. You were to tell us like what's happening in actually the Americas. So please feel free.
Sure, absolutely. Great. So, you know, COVID really brought to light, and as I was alluding to earlier, a cultural shift, a way of people, whether you want to call it stubbornness or whatever, there is a certain segment of the population that wanted to bank a certain way. And, you know, you have two groups, financial institutions, at least in North America, they go after the emerging wealth generation, those that are the future doctors and lawyers, those that are going to inherit the wealth of the established wealth generation, and then you have the established wealth generation. And the established wealth generation, you know, they somewhat adopt digital, but not fully embrace it. You know, there's an assumption, as you can see on the left-hand corner, that older people, again, people that hold the majority of the wealth, will never really use internet banking or digital banking tools to the extent that the younger generations will. You know, there's also been other assumptions that, you know, prior to COVID, that internet banking and mobile banking could basically do everything that needed to be done, and do it digitally. And then the third assumption prior to COVID was it is hosted, so, you know, someone doesn't have to be in a server room. It can handle this unlimited amount of capacity, and there's not going to be a problem. Well, as you can see in those segmented articles, wrong, wrong, and wrong again. You know, we had in at least the United States to stimulate the economy, almost every tax-paying adult, and even folks that didn't pay taxes because for whatever reason didn't meet the income threshold, as long as they filed their taxes, received a stimulus check. So you're talking hundreds of millions of people at all one time through a payment system, that payments were hitting to all these financial institution bank accounts. One thing it clearly showed was our digital, our payment rails, our digital rails, everything could not handle that type of volume and capacity, nor could it go ahead and properly post those payments and show the customer what payments were from whom. So for example, I filed 2 tax returns, but I have a joint account. Was that payment applied to me or my wife? Because we filed separately. And so it created a massive confusion. Banks and credit unions couldn't even handle the call volume, and it took days, sometimes weeks, to get answers on the stimulus, because you couldn't do the research that you need to do on digital banking. You can get all the metadata and information that was being passed on through the ACH to see it in the digital bank. So again, it's just a complete cluster. And then, you know, the older crowds, right? So now they had no choice. Either they were going to wait on hold for 2 days to get an answer from Bank of America or Chase or even their smaller institution, because all the financial institutions were shifting their resources to help these businesses with the stimulus programs that they had. So they were not necessarily ignoring, but they simply didn't have the bandwidth to support over the phone the massive amount of calls, because all the branches were closed. So now you have folks that really never, a whole generation that really never used digital banking, using it every day to reconcile their accounts, to do the other things. And what they realized, and what everyone realized quickly, is when you took the branches out of the equation, oh my gosh, this robust digital banking system wasn't robust anymore. It didn't matter what institution you were with, whether you were with Chase whether you were with a mom and pop institution, a credit union, 100% acknowledgement that digital banking was never meant to replace a bank. Now, you could say you have your direct banks, like your Allies, your Marcus by Goldman Sachs, but if you look at their models, they're pretty simplistic models, right? They're not meant to offer a ton of complex products that some of these larger banks offer. They keep it simple, right? They purposely say, you know, here are our tool sets, and this is what we can do. How they take payments may be simpler, but in terms of researching a transaction, putting through a dispute, doing all these things, not as easy. And so, you know, the last thing, you know, there's now a question at least in North America, about the relevance of branches. Even after we've progressed through COVID-19 and the relaxation of going out and starting to get back into the community, we're not seeing the branch traffic, which is now bringing two principal questions to the stage. So you already have financial institutions saying we are closing branches, whether that's 25, 40% of our branch network, because, you know, we're not seeing the value. But the question is, when and how they're doing it, can digitalization support that, right? And so you have a lot of questions from financial institutions. How do we empower that? And so one thing Murray talked about earlier was APIs and the criticality of APIs. You know, one thing Europe has been really good about from a perspective is giving customers control of their data and determining what they could do with that data. So with open banking. And we had a tool here in the United States that was recently acquired by Visa. It was called Plaid. They're pretty much, I think, throughout the world in terms of exposure. But by no surprise, Visa picked them up at a 54 multiple, right? So that should tell you the amount of investment a company like Visa sees in open banking, connecting data, and really digitizing things. So, and you're seeing a massive ramp up, at least in North America, with the spend of digital. So the digital piece, but then there's the other piece of data and connecting the two together, and you're going to see some other recommendations. So most financial institutions right now, I think it doesn't matter where you are in the world, are focused on lowering your OPEX, right? You know, both your CapEx and OPEX. You're lowering your costs because, you know, you don't know what to expect. Unfortunately, COVID could resurge. There are other underlying economic conditions, massive layoffs in different areas. Obviously the central governments are trying to stimulate, but that's only going to do so much. But we're seeing there's going to be natural retraction, and those are institutions that are financing to those industries that are experiencing natural retraction, which now they're going to you know, absorb losses, so they have to stem off those losses, as you well know, by lowering their costs. And now what we're looking at here is, you know, if you look at your internet banking and what you were able to do before and really analyze it, I alluded to one, which was you know, you disputing your transaction. So let's say I wanted to do a card dispute. Let's say I wanted to do a payment extension on a car loan. So I'm an institution, I'm giving you a 30-day reprieve. There's paperwork, there are things that need to be done. Can you do that all digitally? Can you put that request through digitally? Does it have to interact with a human? How is the human interaction happening? The workflow. You know, what if I'm a person that now lost my job and I was in a checking account that offered more privileges with a higher average balance, but my higher balance is going to be lowered. So do I have the ability in digital banking to choose and downgrade my checking account, or do I have to go on a phone call and have paperwork signed to me, right? So you sent to me and signed, and then I send it back. So you have the cost of, you know, the postal, someone processing that, printing out the forms, someone's, you know, filling out, signing it, someone receiving it, someone entering, acknowledging it. So it's a massive human cost. And I think we can all agree on this call that a digital automated way exists. So really focusing on your customer channel optimization. And trust me, it doesn't matter what institution you're with, you start listening to your customers, you start tracking those friction points, and there's going to be a huge list of them. And it doesn't matter what digital banking solution exists out there, none of them 6 months ago saw any value on digitizing end-to-end where there was no human interaction or very little human interaction. And that's the optimized state we need to get to. And really and truly, if you look at all the tools that exist in fintech today, you could do that. But one of the key aspects of that is the integration pieces, right? You have to integrate to all these disparate systems. Now, you're going to have some problems because some of your vendors are going to be very closed-minded and say, well, we're not going to give you access to that. Well, that's the power of you as a financial institution to say, well, I'm just not going to do business with you anymore. So, you know, you should obviously focus on channel optimization, the things you need to do, check with your vendors on the things you need to do, how open they are to connecting those data components. And with this panel here, you know, all the folks here on this panel here have tons of digital experience and obviously can help you with that too. But, you know, really and truly focus on the facts of each of those elements and the things that you're experiencing in the process, and then look at your systems and then start figuring out what you need to connect to build that end-to-end automated workflow. And then if we could go down, to recommendation number 2, you know, the technology and automation that exists today in your systems. You know, a lot of institutions aren't aware of it, but there's a lot of business rules engines or components in your current systems that you never really took advantage of, right? There might be additional functionality in there that you could take advantage of. This is the time to kind of dive into that too, right? Looking at the business rules engines, any decision configuration models that can be done, you know, really engaging on content that your folks can access, right? I know you probably heard a lot about chatbots, but don't underestimate chatbots. You know, the technology of natural language processing, similar to what everyone probably has used with Alexa or Google or pick any of them, they've become better and better. And you can use those tools to empower your digital solution, so that way you can put self-help tools. So again, instead of your customer calling and waiting and having a horrible experience, enable that content out there so they can figure out how you can help them, right? What is that next step? Because you could even build all these tools digitally, but they're still going to need some guidance. And there's a lot of automation tools out there that can help them and provide a natural, like, human experience where they can get those immediate answers. I hear a lot of times, especially with chatbots, that you know, they thought they were texting or communicating with a human the entire time, and they weren't. But that's how well the technology over the past years has evolved in that area. So, you know, I brought up this little design here because we had 55 million businesses that qualified for up to a $2 million forgivable loan. And you heard that right, forgivable loan. You're not familiar in the US. So institutions couldn't handle that volume. The systems in itself were broken. And so what some smart institutions did is they wanted to get as much as they could, because those institutions in processing the loans, the government was going to give you 5% as an agent fee, basically, to process those loans. So it was easy non-interest income for them. And so you saw the innovation start coming out about how connecting that. And as you can see, each of those green loops, those were systems. You had a human interaction from the person applying at the very beginning. And each of those interaction pieces were automated. And there was a rare component of exceptions that had to go to humans at the institutions, but most of it flowed through the process, which allowed that, several institutions that adopted this to take advantage of the market and make hundreds of millions of dollars in fees from it. So, that this was, again, something that showed the underlying value, and I think more than ever, you're going to see real growth in that area. And then finally, as you can see, the technology and automation cases, you probably have seen it today. Consumer loan processing, you might have done it where, you're going and underwriting a loan instead of, from the underwriting to approval to the funding process where you're re-entering it. You're now having APIs, basically take all that data and move it to the next system and move to the next system to process those loans faster. So you can see some of those cases right there that are, again, very low-hanging fruit from a digitalization perspective that can heighten your automation and lower your costs. So really focused on, and what we're seeing here, data automation, so data connectivity, data security, monetization of the data, data aggregation. We're seeing that in droves, and there's a lot of investment here, and it's truly exciting time. It's not talk anymore. Really, COVID has accelerated this to become a reality.
Okay, thank you, Rich, so much. Actually, it was very interesting, at least to me, to hear very, very different perspectives from around the globe. Actually, the transformation from Africa using, in some countries, only 1% of the transactions in digitalization to America, particularly to USA, where the banks and although digital system exists were clocked by the demand. It's kind of a different world, but I'm seeing similarities that things are happening around the globe in the same way. Just because we are entering our Q&A session, I would remind you one more time, you can ask us questions all the time, and now is probably the best time if you're going to, because we are going to look at those questions and ask to the panelists. And actually, before you're typing your questions, I would want to ask a question to all the panelists. In matter of time, please answer shortly so we can have time for more of the questions. So fine, we understood what's happening in all these parts of the world, but if you need to name within 1 or 2 sentences, what are the winning digital strategies and how you can jump the digital line, what would that be? So maybe in the same order, Philip.
Okay, I would say the following. The best digital strategy is nothing to do with digital. Improve your time to market, improve your flexibility and your decision-making and execution capabilities. Yes, that will lead you to digital, but that will transform you best.
Okay, very interesting. Murray?
For me, it would be simply one word: interoperability. Banks and fintechs have got this challenge, winner-take-all mentality and siloed solutions. And I think that digital transformation is a broader social, economic, and business objective to create a level playing field for interaction from banks and non-bank financial institutions to provide access to financial services. So we need more interoperability to be successful, to create a good, healthy financial services ecosystem.
Okay, very interesting. Rich?
Yeah, I think it comes down to you have data with a lot of digital connections, monetizing that data. So nothing will increase the spend and investment if you can show how you can immediately make money from a digital side. So digital, I think the next advances in monetizing the data.
I see. So let's focus on the questions. Some of them have been asked during. Yes.
Can you answer your question yourself?
Okay, that's maybe a good challenge back to the moderator. Actually, to me, I believe I mentioned it in the beginning. Integrated platforms that can be used in various channels to give you a quick time to market. What we have been seeing, I mentioned some systems do not have that capabilities, and the organizations that are not investing into kind of omni-channel platform play and other strategies like that, they don't have the capabilities to respond to the needs. And of course, this cannot happen overnight, but when somebody has a kind of a clear strategy how to arrive there, even the first projects that they can implement can be part of building that platform play. So that would be my short answer. Thank you for asking. Actually, quite a number of questions. We don't have much time, so I would ask maybe one question to be answered by only one panelist, and you can decide who would like to take it. So the first one is somebody is asking specifically that we see uptake on personal finance management applications before the COVID. What do you think is going to happen with so-called after COVID, considering that a lot of people will be under a financial crunch? Who would like to answer this one?
I'll go for it.
Okay.
I think you can see it by some of the app evolutions. So here in North America, we have an app called Credit Karma. And Credit Karma was one of the first about 9 years ago to come out with aggregation. They, at that time, partnered with TransUnion, which is one of the credit reporting agencies. So you didn't have to enter in all the accounts. They had it already from your credit portfolio. But to your point, what they're doing now is they're being proactive in looking at, okay, we can look at your trade line of your debt and we can recalculate it, and we're already reshopping it based on your credit score on the soft hit of how to lower the finances. So it's saying these 4 bills, you're paying an aggregate of $2,100. If you refinance and we can help you with this workflow, we can bring you down to $1,500. And so now you're seeing that not only the recommendation, but they're going and shopping and helping you, right? And Credit Karma is making money because they're getting promoted or they're promoting certain financial institutions, right? So it's creating a marketplace for it. But to your question, that PFM is now leading to solid recommendations. Not a recommendation you should apply for this loan because there's a lower rate. It's giving you quantifiable results of this is what you're paying today, this is what you could be paying tomorrow, and we could cut this much out of your budget.
Okay, very interesting. And I see several participants asked similar question. What is your opinion about the digital banks? And particularly one participant is saying Hong Kong, Singapore, Malaysia, they already started such kind of things. Where do you see the place? Are they going to replace the existing banks? And what's the future of the digital banks? I think here maybe more of you can take participation.
Can I offer something on that?
Sure.
Digital startup banks are quite prevalent in emerging markets. One of the biggest challenges for a bank to move into digital is not so much the technology, it's the culture, it's the people. So you have a large bank that has got a very hierarchical organization structure and a culture around dealing with its community, its people, and its organization. So large banks will sometimes spin off a digital bank to try and, like a lifeboat, and then migrate a lot of transactional accounts into that new digital experience. Others are brand new startups. They tend to be fairly narrow in focus, tend to be focused on the mass market. I think they're going after the low-hanging fruit, which is the part of the P&L that's just transactional banking, which they'll harvest from some of the larger banks. larger volumes of low value accounts, but they'll eventually grow out their services. They can start acquiring businesses and providing other services. So they will build out an experience over time. There's one that was launched here last year in South Africa. Now they're topping out at about 1.8 million accounts. That's not bad considering that some of the banks here that are 40, 50 years old have got only 9 million accounts. So it's a big impetus, and there's a lot of digital banking that's starting with the mobile operators. The Kenyan central bank has just licensed mobile operators to take deposit-taking financial institutions to become, they can only have the liability side of the balance sheet, but they're PSBs, payment services banks. They know how to do digital transactions and payments. Now they're going to be able to actually hold deposits. So I think we're going to see a digital transformation largely around banks that are app-based, mobile interaction-based, less physical infrastructure. We're going to see a lot of physical infrastructure shed over the years, and a shrinking of the large banks into the more high-value, interactive kind of client engagements and corporate banking, where they can be, where they can maintain their profitability, and let a lot of the transactional banking go to these startups. So I'll leave it there.
Okay.
If I could add one thing too, it's not only the startup banks, but you have banks within banks, right? So you have the large banks creating digital banks, and their philosophy around this is, if I have a successful digital bank that a challenger bank within the bank, and my customer's not satisfied on the traditional bank, they can just move over and I can give them an alternative, and they're not leaving the bank. And so you see a lot of financial institutions creating those bank within the banks, which they're just built on a digital platform. Takes them away from all the legacy, so they're not on the legacy stack. They're creating their own brand new stack. They're creating almost an alternative brand in an alternative market. But what they were typically targeting was that emerging wealth generation, which the legacy bank wasn't successful in doing. So I think you're going to see more of a proliferation around that too.
Actually, very good addition, Rich, and that leads me to a question which has been asked by many participants, and I think it's very good for the last question of the presentation. It's in summary, it looks like, what is your long-term vision of the future of banking? Especially, have you seen it change because of COVID, from what you were thinking 3-4 months ago? So maybe Philip, you can start first. Or less than a minute.
Faster, smarter, connected. I would say this is the future of banking. We can say which would be the technologies for that. And I guess, Helena, would push you to maybe chime in with this. But this is my future of banking. Faster, smarter, connected.
Okay. Murray?
Well, I've got an old saying: wherever you have a phone, you have a bank. It's going to be mobile, and it's going to be very much the winners and losers in this mobile digital banking world will be the ones that are able to own, control, and manage data effectively. Any financial institution that allows a third party between them and their client that is going to be able to harvest data will be disintermediated. So I think it's about data, it's about mobile. Thanks.
Rich?
Yeah, I think, we're constantly looking at the future generations, like how they interact to digital, right? And it seems like they want more socialization in their digital banking. So one really popular app that's grown now from the United States, has gone into the UK and Europe, will go to Asia probably here in the next few months, is an app called Robinhood. And this is a company, if you think about it, started 4 years ago, and is much larger than Fidelity and E-Trade and a lot of these other institutions. And what they did in their banking application, so they have trading and they have cash management like a checking account and whatnot, is they made it socially interactive. So if people, want to know what their friends are investing in, or what products their friends that they recommended into the banking app, selected, you know, the socialization of recommendations is super important to them too. So I think, you know, the social aspect of it needs to come into banking to be relevant too, especially to these future generations, because that's how they interact. Otherwise, they're going to look at other channels because they're not taking recommendations necessarily from experienced bankers. They look at social, the social group and what they're doing. So I think that model, and you look at others in the industry that are being successful, you're seeing a common theme there: social engagement.
Okay. I actually think whatever the future of banking is, it's going to be very exciting, very dynamic, and a lot of changes and challenges ahead of everybody in this sector. So if the audience have more questions, I can see more are coming, but unfortunately we don't have time. Please send it to this email that you're seeing on the screen, and I will personally make sure that all the panelists are answering the questions that you have. So with that, I want to say a big thank you to our panelists. Thank you, Philip, Marie, and Rich. I think it was very interesting to see the perspective, what's happening on the different continents, to see how there are linkages on many of the things you are discussing. And of course, thank you so much to all the participants. If you liked the discussion, we promise we are going to continue. Thanks.
Thank you so much, Colin.
Have a nice day to everybody.